So another financial year has passed and it's been a fascinating period for investors. In many ways, it's been the tale of two halves, with significant weakness in share markets in the final quarter of 2018 really impacting investor returns over that period. Indeed, many diversified portfolios saw the greatest losses that they have seen in the past 7 years. We had the US equity market, the Japanese equity market down by as much as 15%, which really undermined investor confidence. Now, much of this had to do with the outlook for rising interest rates, particularly in the US, just as we were starting to see some weakness and some concerns around global growth expectations. However, looking into the second part of the financial year, and it's really been an extraordinary period for investors. Share markets in many cases have delivered double-digit returns, while bonds have also performed very well. The reason for this is the change in outlook of central bank policy, not just in the US, but also in Australia, with central banks becoming increasingly supportive of markets. After such a strong period in markets, we find valuations in shares and bonds increasingly unattractive. This means the risk of loss is significant, and our portfolio positioning is as defensive as it has been. This is not to say that we are forecasting some imminent decline in markets. We are not. We just need to position for where we see the most attractive reward for risk. As we look across share markets, we find the Australian market and the US market generally unattractive. We continue to prefer investments in Japanese companies and UK companies, as well as sectors like consumer staples and healthcare. Within bonds, the risk of loss again remains elevated, and so we prefer shorter dated securities both in Australia and in the US, and emerging market bonds. We also continue to hold higher levels of cash in our portfolio, which we expect will help buffer the portfolio from any volatility that might come along. As a final comment, it's understandable for investors to look at the past 5 or 6 months of strong share market returns and project them forward as reasonable and sustainable expectations for the future. In our view, they are not. The risk of loss remains elevated, and we must move to preserve capital as best we can in our portfolios. After all, we are not so much trying to beat the market with our investment objective. We want to deliver an outcome for clients that's going to help them achieve their goals over the longer term whilst preserving capital along the way.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.